please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
This is Bazaar Morning Call, live from the CNBC TV18 headquarters in Mumbai.
Good morning, welcome to Bazaar. I'm Lata and with me are Anuj and Sonia, and I think that montage that our producers played out to you aptly captures the mood in which we are going to start trading today. I just want to put one point on the table. Yes, it's the first serious correction. I mean, up until last week, we were boasting for the Dow 68 record highs in the last 365 days, 66 record highs in the last 365 days. And even in January, we were speaking about 11 trading record highs in the month of Jan, or whatever number. So clearly, when the correction came, it would come swiftly. But I just want to put one point on the table. Until Friday, we were saying that yields have risen to 2.86 in the US and Indian yields have risen to 7.8, and that's why the market was finding debt attractive. Yesterday, the yields fell. Yeah. Bonds saw savage buying. That US 10-year, which was 2.86, is now 2.7. I mean, it's a 16 basis point correction that we have seen. So clearly now the market is falling under its own weight. It's probably program trading. It's probably that once fear takes up, it's a velocity all its own. And the VIX is telling you that the fear index is about the highest that we have seen in years. I mean, so now I think at some point in time, I guess the market will recognize that there is value. But this, as Anuj always says, respect the ticker. There is nothing wrong with growth. Yeah. I mean, the growth numbers, whether you look at India or US earnings. I was just reading the Motilal Oswal numbers. They have pointed out that 68% of the companies that have announced so far and which they track have given in-line or higher earnings. And in the US, I think that the number is 80% in-line or higher earnings. So it's not growth, but probably too much of growth.
Yeah, too much of a good thing maybe. Yeah, even China, the PMI data that came in yesterday, we established this point yesterday, right, that growth is just doing fine. Lata, morning, Anuj, morning. So that brings us to the key question. What do you do when there's a brutal global stock market rout? As an investor, do you sit with some cash or do you start to deploy? Because this is a correction that savvy investors would have been waiting for a very, very long time.
Morning, Sonia. Morning, Lata. You know, as this is so sonar ki ek luhar ki. Bear blows are like this. They wipe out, you know, your months and years of profit in 2 or 3 days. And that is why in stock markets, you should not get too cocky. You know, we were discussing this, right? I mean, this has no correlation, by the way. I just want to put this on record that I'm not saying this is no correlation. You know, we spoke about it that you should not assume. You should not assume that you will make 60,000 crore or whatever via long-term capital gains tax. There's a chance that you will make zero money because, you know, there's a good chance that a lot of stocks will not hit their 31st January high before the financial year ends. Yes. Okay, so that point should be, you know, clearly taken on account. Now, the point here is, and, you know, I was having this bit of a fun chat with Mangalam and Anisha as well in Power Breakfast. You know, we have seen this 2004 fall, we have seen the 2006 fall. A lot of this new money which has come in has not seen this fall. Not from investors' point of view and not from some of the recent star fund managers' point of view as well. They have not seen correction. So this market is now set for the first correction of the bull market. And there's a good chance that you make a move towards the 200-day moving average of 10,020. Because now 20, 50, 100 don't matter. They matter in a trending market. Now something has gone wrong with the market. Dow futures even now I think is down after already falling 1,200 points. And by the way, you know, yesterday I realized how long a night can be because, you know, it started 500 down.
Yeah, then it went 355 points recovery.
Then I checked at 10:30, it was 350 in the green, and, you know, I thought, wow, what a market. And then I slept and then I woke up and, you know, saw my timeline.
I was not prepared for 1,500.
And, you know, it was like 1,500 point Dow down, CBOE VIX up 120%. Yeah. But, you know, this is what will happen, you know, if you just keep selling volatility. At some point, you know, it will raise its head. And, you know, Lata, totally take your point. You know, you should respect what the market is saying. The market was giving warning signs through January when the advanced decline was negative. Now, the big question for me is how much will the market fall and how will the flows continue? Anecdotally, you give up 1/3 of overall gains. The bull market started from 7,000. So from 7,000 to 11,000 to 4,000 points, there's a good chance that you gave up about 1/3 of that. And that's normal. That's a normal bull market correction. You can even give up 50% and still be in a bull market. Correction territory, of course, but the mid caps and small caps need to correct a lot more. They need to see the excesses totally taken out. You will go through a period where in the mid caps and small caps, equity will be a bit of a hated word, and that would be the time when you will see a big
Is it already that bad? I mean, I was under the impression that after the monetary policy for India, there will be a bit of stability because that will be the last big event out of the way. I agree now we are falling on global velocity and not on Indian news at all. It has not at all got anything to do with LTCG.
Yeah, of course.
It's clearly a global market. But I mean, do these things take that long? After all, the growth numbers are very good. I guess we'll pose these questions to all the experts who come.
I'll answer that as well.
Growth will have to reassert.
Exactly, I'll answer that as well. But Sonia was, asking something.
Yes, in fact, no, since there's no real reason for this correction, that everybody knows the way bond yields went up for a really long time, everybody knows growth is good. As a long-term investor, do you, muster up the courage and go out there and buy now? Because you are getting some good value.
Who was it who said that in long term we are all dead anyway? But, see, just to combine both the points, when the markets are going up, we don't ask why are the markets going up.
Of course.
Simple, right? So that's why we should get out of this business of why the market is going down. We should get in the business of what we should be doing. And I think on that I take your point. I think if you are into SIP business, then absolutely no reason for you to withdraw that, to quit it, because there's no reason. The concept of SIP investing is that you make money over a cycle, over a bull and a bear market cycle, because when the market's correct 30-40%, the same SIP of 25,000 is going to give you more units of the same mutual fund. So that is why on the way down you should never actually stop your mutual fund investments. What you should do is you should prepare a list of 10 or 20 good quality large caps, non-index large caps or index large caps, stocks that you always wanted to buy but you could not because they were out of your comfort zone. And every time the market gives you days like this, put in 5% maybe if you are in cash, and then just forget about them for 2 years, and chances are that by the time this thing is done, you would have made a lot of money. But for today, there's no harm in selling as well. So, stocks which have rallied a lot, where you have a lot of leverage, someone else would be in pain because you have to give the stocks. So, there's no harm in taking short trades today, intraday point of view, even if it means that,
word of advice. I tried to sell mutual fund units. I tried to stop an SIP. Some time back, I had to pay for my son's admission. And you can't stop for the next month ahead, If I say today, stop my SIP hereafter, they will say, no, next month is also gone. 10th ko leke hi rahenge, uske baad hi. They have this convoluted theory that some agent does it. No. I mean, this is strange. You can't stop an SIP for 1 month ahead. After that, you can stop.
Who was it? I think it was Samir, if I'm not wrong, who said that, that this mutual fund NAV business should be looked at on the way down and not on the way up. That's where the NAVs are calculated. And look,
No, I stopped for a reason, because I wanted the money.
And this is serious business. I just want to make one point, because we are all commentators. So, for us, of course, we have our mutual fund investments, of course. So that also takes a hit. And so do our ESOPs. But, the point here is that something all of a sudden has changed globally, and the market has shown classical patterns of a meltdown after a melt up. You had a melt up, and now you're having a meltdown. And all these asset classes are linked. You make money in cryptos or stock markets, you're funding that into cryptos. Yeah. Now cryptos all of a sudden from 20,000.
They fund each other.
Bitcoin is down to 6,000. You're scrambling for cover there. So you're selling the stocks where you're making money. All of this is interlinked, right? And all global markets are interlinked, and that's what's happening right now.
Okay, well, let's see how it progresses from here, or maybe deteriorates from here. We don't know. But let's take a look at what our wise experts have to say. We're getting a lot of comments this morning. Sean Darby of Jefferies says the recent market correction appears more to do with the unwinding of the reach for yield theme than economic fundamentals or credit issues. He says the speed of the sell-off in government bond yields has unsettled equity markets, given that real interest rates have been negative in many cases. He says there's been a strong correlation between equities and a reach for yield theme ever since the global financial crisis. He adds the usual suspects, the dollar and emerging markets like China, however, are not to be blamed.
Rhythm Desai of Morgan Stanley thinks the multi-year outperformance cycle for value factors over growth factors probably ended in 2017, reiterates Morgan Stanley call to buy GARP, That means growth at reasonable price stays. He says they're careful about the price that such growth commands, and so their strategy, as it has been over the past several months, is to back growth but at a reasonable price. Rhythm says the risk to this view is that if the growth cycle falters, it could lead to a bounce back from quality and value stocks.
Okay, and let's also get you some money market views then. Let's find out what the views on the rupee this morning. Bhaskar Panda of HDFC Bank says the dollar index has a relatively better day, riding on higher than expected US non-farm payroll numbers. He says the dollar INR was under pressure for a combination of factors, which includes dollar strength, union budget, higher crude prices, etc. He expects the dollar INR to trade in a range of 64.05 to 64.25 for the day.
Well, Bhaskar Panda says on bonds, globally bond yields have moved up. He says the 10-year benchmark bond yield, that's the Indian yield, has been hardening on the premise of sticky higher retail inflation, and he expects this trend to continue towards 7.75 from the current 7.6 gradually.
Okay, but it's all about the global markets this morning. A lot of disbelief this morning about the way some of the markets have fallen, but that's the reality. Here's Nigel with the world view.
Well, it was a roller coaster ride in the US markets overnight. The Dow, they saw their biggest one-day drop that we've seen ever. So from the best start to the year, we had the biggest drop that we saw in a single trading session. The Dow and the S&P 500, by the way, they have turned negative for 2018. The Nasdaq is mildly in the green. And volatility, that's back in the system. First, let's start off with the biggest drop that we have seen. Well, yesterday we saw a drop of around 1,200 points. At one point of time, we were down close to around 1,600 points as well. Those are the previous biggest falls that we have seen, between 600 to around 800 points odd. But the factor that you need to focus on is the volatility index. Just earlier in 2018, it was at around 1112. Now that's up close to around 3x actually from those levels that we saw of around 1112, telling you the kind of volatility that's back in the system as well. We've been blaming the yield for the last couple of days, that it moved to around 2.8, 2.85%, 2.88% as well. 4-year highs. Well, yesterday it's cooled off, and it's cooled off further overnight as well. The big question is what happens to the long anticipated US growth in a higher inflation scenario? And the second question is, what will be the Fed's response? Will they hike interest rates at a faster clip? Can there be more than 3 rate hikes? Those are the questions that are being put forth. You'll say, well, overnight it wasn't a good trading session. Which were the big losers? Boeing was one of the biggest losers, was down 6%. Apple was a relative outperformer because it was down close to around 2%. I was looking at the Nasdaq futures. Well, that's indicating more pain just to kickstart trade today. In terms of the European markets, they ended in the red. But as Anuj was saying as well, there was a bit of a recovery in the US markets at that point of time. Look at the futures. They are telling you it's not going to be a good start today. So just keep an eye on those markets. And the Asian markets, the Nikkei is down close to around 4%. You have the Hang Seng market as well that is struggling. And it's a sea of red. And that would mean that the SGX Nifty starts off in the red with a cut of around 350 points. We'll be negative for 2018 with that kind of a start, and we'll be trading below key technical levels as well. Back to you.
350 points down on the SGX Nifty, and I think even the Dow futures are down as well.
Yes, 1.5.
Exactly. And just one more point, there are no brownie points for catching the bottom, right? I mean, you get a 200-point rally at any point, you get the 200-point rally. So the concept of catching the falling knife. But we have some guests joining us now.
Yes, it's a big day, so we have many guests.
Yes, Jeff Dennis of UBS and Bob Dole of Nuveen AMC, and of course, Arvind Sanger of Geosphere Capital. Thank you. Good evening to all of you, gentlemen. Thanks a lot. What a rough day for equities. Jeffrey, let me start with you. Your thoughts on this brutal sell-off that we have seen over the last 2 or 3 days?
Well, clearly, as far as we're concerned, the whole thing began with the disappointing or the strength of wages, earnings in the Friday payroll report, and that led to a further sell-off in bonds, and that gave you a bad Friday. And I think just basically the selling continued on the back of that. There was a lot of program selling, a lot of just to a certain extent capitulation, I think, driven initially, as I say, by an inflation scare which came through with the payroll numbers on Friday. Now, what has been the big factor here, which I think could indeed have caused the contributed to the scale of the rout, as well as obviously being part of it, is how much the VIX, the volatility index, it went up a record amount today, over 100%, more than doubled. One good sign, I think, is that bond yields did rally, did fall back. There was some buying of bonds, I think, a sense of flying to quality to a certain extent. But we put it all down initially to Friday and the fallout from that, relatively high earnings number.
Yeah, actually, Jeff, that was the point even I was wanting to raise with all of you guys. We thought we should keep looking at the US bond yield, and when it seems to have peaked off the yield, then probably the market mayhem will stop. But yesterday we saw a steep fall in bond yields as well. In spite of it, the market had its worst fall. Bob Dole, if you can explain that to us. The markets fell when the yields rose. The markets fell when the yields fell.
Yes, we have to put this in perspective. The stock market's just where it was 6 weeks ago.
Yes.
A lot of people are acting like this is the end of the world. It's not even close. The U.S. economy is doing reasonably well. And look, the 40 basis point rise in the 10-year Treasury from January 1st is just too fast for the equity market to handle it. Yes, you're absolutely right. Yields have come back to some degree, but the reaction to it is still going on in equities. And as you just heard, there's been some forced selling. There's some program trading. There's some panic. There's some capitulation. And so it should be no surprise that we continue to give back some of it. Yes, this is the biggest point decline, but nowhere near the biggest percentage decline. This is because we haven't had this kind of reaction in markets for quite some time. People are pretty excited about it, and I'm not trying to minimize it in any way, but we'll find a bottom, and if we go higher, it's because the economy is doing okay. That will be the earnings story will be the story if it stays good.
Okay, well, we'll come back to take that point forward, Bob. We also have Arvind Sanger on our panel. Arvind, hi, good morning from India. Global sell-offs in the recent past have been the best buying opportunity for Indian investors, at least. We saw it with the case of the Brexit as well. Do you think this time could be the same?
Well, this time is a little more complicated because India has its own problems. India itself is going to have an inflation issue, and the RBI is probably going to be, much more hawkish than it's been in the past. So you have that. And I think you have the, capital gains, which is unfortunate timing. And you have, bureaucrats talking as if markets only go up, so investors make easy money. And those are, unfortunately, contrarian indicators in terms of complacency on the part of, the government in terms of thinking that markets are a one-way street. And that's, those are all negative factors that are slightly more, more deeper in concern. But I think that, with the growth and everything else, hopefully getting back on track, even with a budget that's a little bit, less, disciplined than we would have hoped. Hopefully the market sell-off in India will wind down. But I would say this is not all about foreign selling and India just feeling the brunt of global factors or India factors.
Okay, so Arvind, are you saying that India could actually underperform? And actually we did that even in the month of January when the MSCI Emerging Market Index went up 10% and we were up only about 4 to 5% thereabout.
Well, it could, but I think one of the good news in the last few days for the Indian market has been that oil has come off. So to the extent that that was one of the negatives, that's lessened. But I think, India had a great year last year. It was one of the outperformers. So the fact that it's giving back a little bit of that outperformance doesn't necessarily make it cheap by itself. I think what will matter now is how the various cross currents play out. How does the RBI policy create any challenges for the economy? How does the growth that we've been all expecting after GST issues get digested deliver? And this quarter was somewhat encouraging. And how does the government remain supportive versus assuming that the stock market investors are cash cows to fund populist policies for the next election? I think those are all factors that will interplay, and I don't think that 2018 is going to be as simple and easy a year as 2017 was for Indian investors.
Yes, we're already talking about it as the good old days now, 2017, isn't it? But Jeff, as a global investor, what do you do? Are you sitting out and just waiting for it to find a bottom? Are you buying? What is the pecking order of equity markets that you will choose?
Well, we haven't changed our view, frankly, and we are constructive about emerging markets, which of course is what I cover for the medium to long term. I think it's just a question of trying to find out, how much further this sell-off could go. Our sense after tonight is that the VIX increase, the volatility increase, may well already be at its peak, but we're not sure yet whether there may be more selling in terms of the S&P in the short term. Now, this is all getting driven, in our opinion, by the U.S. market, but what Bob said earlier is absolutely correct. The global economy looks good. The U.S. economy looks good. Earnings look good. And frankly, what has really helped emerging markets to hold up relatively well in the face of this big sell-off in the U.S. Is that the dollar has not rallied to any great extent, and that's minimized. There's been some currency selling in the end, but it's minimized that. So, I think you just have to wait and see. This thing is going to blow itself out. It's not going to lead to a dramatic, rout of a large amount from here. And at that point, I think you have to take another look at emerging markets again. And we like places like Brazil, we like Russia, we like Korea. As you know from a previous interview I did with you a few days ago, we're a bit more cautious on India now. But I think we just have to see where the bottom is in the U.S. And frankly, it may not be that far away.
Okay, so that brings us back to the question about what the U.S. market could do from here. Bob, this U.S. market tumble throws the Fed rate hike schedule into question, because we all know that the government, including your president, is very cognizant of, the kind of impact that all of this has on the stock markets. Would you change your view on how many times the Fed could hike its rates through the course of the year?
On the assumption that this is a good old-fashioned correction and has not a lot farther to go in terms of price, I would not make any changes at all. We do need, as everybody's mentioned, to keep a careful eye on inflation. The wage number was troublesome, and that calls into question how many rate increases the Fed might go. Now, we also know that monthly number is a very volatile series, so we'll see how that shakes out. But I would not change my view on the Fed going 3 times this year.
Okay, not 3 times this year. That will be interesting. Arvind, so for, back home, the big question that a lot of portfolio investors are asking is what next? And this market has been driven by retail flows, but, a lot of that money has not seen any correction. So this would be the first genuine correction. So what should be the portfolio approach from domestic investors' point of view who have put so much money in the market over the last 2 years?
Well, I think, to the point that somebody else made about the U.S. market, that all we are seeing is a correction of people are panicking like it's the end of the economic cycle. I think the same thing applies to India. The economic cycle or the growth cycle, notwithstanding whatever RBI does, is still intact. But I think one of the things that portfolio investors need to keep in mind is that at the end of the day, in calculating the PE multiple for the market, the interest rates are in the denominator. And if interest rates are going up, into the extent that you discount the earnings, then whether it's the U.S. market or it's the Indian market, the PEs may have benefited from, low real rates, and those PEs might moderate a little bit. And I think, therefore, it's a fine line between, is the growth coming back, and what does the interest rate environment suggest, the earnings multiple that we can pay for that. I would say, that's a long-winded way of answering that. I think portfolio investors should be opportunistically stepping up into companies that they like. You can never pick the bottom. The bottom we only know looking in the rearview mirror. But I think there are a lot of good companies that are going through a severe correction. And if people are disciplined about long-term value, then there will be good opportunities here over the coming days. And I don't think we're that far from in terms of number of days of sell-off, in terms of us, finding some kind of stability. But there's no point rushing in and putting all the money on the table, too quickly.
That's cautious optimism. Gentlemen, thank you very much for joining us. Arvind, just one final question to you. Which stocks are you looking at in this fall? Would it be IT stocks in India? Would it be, economy-facing stocks like, say, a Larsen?
I think it is some of the economy-facing stocks. I think it can be companies with, maybe more rural exposure, which clearly the government is going to be doing more spending in.
Okay.
I think it'll be infra. I think the area that has been a big winner in the last year, which is financial-related stocks, could be somewhat less out of favor. NBFCs have been an easy win in the last 12, 18 months, and those could be somewhat less attractive as compared to some of the real economy beneficiaries.
All right. Thank you very much indeed for joining us. Yes, NBFCs, they were stock that probably some of their money is also in capital markets, in which case you're going to see some selling in NBFCs.